Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hello, everyone. Welcome to a very special episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, it almost brings a tear to my eye. This is the last podcast we're going to do all year. You're not crying, are you?
No. Merry Christmas, Happy New Year, Happy Holidays to everybody. Thank you for all your support this year.
Absolutely. Today's going to be a lot of fun. Today's podcast is actually sponsored by our friends at Y Charts, so thank you to Y Charts. This is episode 65. We're titling this one, Discussing NDR's 2024 Outlook with Ed Clissold. Ed is back. Ed, you were back. We were joking before we hit record. You came on in early March. I think it was episode, I wrote it down, 22. And we had a banking crisis right after you came on. What do you have in your bag of tricks this time for us?
Yeah, let's go outside the banking sector. Let's hit maybe private credit or commercial real estate. It's loads of options here.
Yeah, there's lots of fun stuff to do there. But Sonu and I are really excited when we kicked around the idea. So we are pre-recording this just so everybody knows if something really crazy were to happen. What is today's date? Today's like the 6th of December. So we're doing this early. If something crazy were to happen, we're talking like how we know the world on December 6th. Hopefully it's nice and calm. But we said, who do we want to have on to talk about, next year's views? And Ed, you were at the top of the list. And what's really cool, I think it was yesterday you released your outlook, right?
It was, yeah. So when you asked me, I said, well, that's perfect timing because we're scheduled to release our report just the day before. So good deal. Great minds think alike.
Yeah, absolutely. I've had a chance to read it. I know Sonu has as well. I mean, Sonu, you want to fire away? I mean, well, you know what? No, let's start big picture, Ed, because some people might not know you, although they should. Right. Tell us a little bit about yourself, what you do at Ned Davis Research, how long you've been there, I don't know, your favorite food, whatever you want to talk about. It's the last podcast of the year. Let's have some fun.
Yeah, so I've been at NDR for over 20 years. I was a client and thought, boy, that'd be a fun place to work. And it has been for over 20 years. And what I really like about it, first of all, the people are fantastic. There's curious people who put their egos aside. We let the data do the talking for us. I view my job as to sift through our thousands and thousands of charts and indicators and models, and then try to find some similarities to weave together into a cohesive message. And so I get to do that for U.S. markets, but I get to also lean on some brilliant economists. I know you've had Alejandro Grindal, our chief economist, on a couple times, and lots of other great strategists at NDR. In terms of say favorites. I think Ryan, you and I are a little bit in the dumps over the NFL season. My Tennessee Titans are in full tank mode, and your Bengals are waiting until Joe Burrow can heal up. But I think you guys have a much brighter future than we do.
By the time we're recording this, I might look like a fool, but the Bengals did look pretty good on Monday night against Jacksonville with their other quarterback. We don't make this all about sports, but who knows? Maybe there's a glimmer, but you're right. Without Joe Burrow, they're limited.
I live in Chicago, so there's a low bar for you all.
Do they have a football team, Sonu? I didn't. I've never heard.
I don't think so.
Chicago? I didn't know. Yeah, that was for all you Packer fans out there. Anyway, all right, Sonu, let's get the ball rolling, man. Fire away with that, Ed. We're so excited you're here. Let's talk about the world next year.
Yeah, I think one thing about Ned Davis Research I love is that you, as you said, you have some great economists, but you keep such a good pulse on the markets, right? And ultimately, that's what counts, right? Because what are people thinking? What are people pricing in, right? So I'm curious, like in 2022, when we came in, I think it was clear as the year progressed, what was not being priced in was inflation raging to 40-year highs, right? The Fed was behind the curve. They had to raise rates aggressively. 2023, I think the story was kind of higher for longer. People expected rate cuts at the beginning of the year. That didn't happen, especially after the Silicon Valley bank crisis. Nothing panned out. No rate cuts, right? In fact, we got rate hikes. The last one is July, and hopefully that would be the last one. Going into 2023 then, what do you think is the big driver? What's going to be the big story?
Well, I think, unfortunately for those who don't enjoy watching the Fed and creating their investment thesis around what Jay Powell is saying at the moment, I think it really is about the soft landing versus hard landing. But I think the good news may be, as you articulated so well, after 3 years of following the Fed cycle, are they behind the curve? Is it transitory? Have they pushed too hard? I think we're going to get somewhat of an answer. I mean, the nice thing about the markets is you never really get the answer, right? You're constantly trying to solve the puzzle, but you just get to wake up every morning and try to figure out what the next question is. But I think we're going to get a pretty good answer as to whether or not the Fed can land the plane. And it's going to be turbulent as we go here because some economic data is suggesting the economy is not in great shape. Others are saying, we're actually going quite well. And then also we have the question of, how much inflation can fall from here. But, our base case is that the Fed is actually going to be able to pull this off. There's some underlying strength in the economy, especially in the labor market, that may allow them to, as you said, probably they were done with rate hikes in July, and now they'll probably be able to cut a few times next year. I'm not sure they're going to cut as many as maybe what the market is pricing right now, which is 4 to 5. We think they may hold off a little bit longer, closer to mid-year before they do the first cut. But the reality situation is if inflation's coming down and may, get towards 3% or lower, then why do we need a Fed funds rate at five, almost 5.5? There's room for them to lower rates, which would allow for the soft landing.
So, Ed, when I looked at your guys' 2024 outlook, I think I saw about a 30% chance of a recession. Does that sound accurate? Does that sound like what you wrote? Do you remember what you wrote?
Yeah. Yeah. So I'll credit Vanetta Dimitrova, our U.S.
Mhm.
economist, who came up with that. But yeah, and Vanetta and I were joking about that. What does 30% mean? Because that was
Mhm.
not a typical NDR, extremely quantitative. Here's our model
Right.
probability.
Right.
It was more
Sure.
like looking at it. This is kind of say, what that means is the risk is there. It's definitely not our base case.
Sure.
We really don't think it's going to happen, but we don't want to say it's absolutely not
Mhm.
happening. So
Mhm.
it's not off the table because, well, first of all, you don't know if there's going to be a shock. But the Fed, let's say inflation ticks higher for several months. The
Yep.
Fed may feel compelled to hold rates up higher for longer, maybe even do one more hike because there's a political aspect to this. I know no one really likes
Mhm.
to get into the
Mhm.
politics side of it, and I'm not going to get into what people's political views are, but the Fed doesn't want to be involved. And so if they're going to do one more hike, boy, they'd rather do it early. If let's say they're on hold and they have to hike
Right.
in July, like that would be a disaster for the Fed.
Sure.
So
Mhm.
there's a small risk there that the Fed may, uh, in an effort to not flip flop, could actually make that policy mistake that everybody's been so worried about.
I want to jump in here. So we'll talk about your views on stocks. I know people are probably excited about that, but let's focus on the economy just for another minute because I love what you said earlier, where there are certain parts of the economy, if you look at the data, that says, wow, maybe we're in a recession or heading to one. Then there are others that tell a wildly different story. Now, one of the things Sona and I've talked about, and I think back in March when you joined, we talked about this also, soft data versus hard data. A lot of the soft data, your surveys, your investors' surveys, saying one thing versus retail sales saying a wildly different story, consumption saying different story, manufacturing, ISM's kind of below 50 for I don't know how many months in a row, a lot of months in a row, contraction of manufacturing. But then you look at the hard data, we're seeing a good deal of manufacturing taking place. I mean, how much weight do you guys put on soft data versus hard data? And have you ever seen a time like this where, again, people feel one way, but they sure do another?
Yeah, I think it's a great question. So what we try to do is not hang our hat on any one indicator. For example, the leading economic indicators, which is a very good
Mm-hmm.
composite of several different
Mm-hmm.
data series that have a great history of leading the economy. Well, it's been suggesting recession for quite some time.
Yeah.
But what we do is we have a recession watch report, which is 8 or 10 different indicators that have a good history. And so the LEIs may say, oh, look out. But if you look at like financial conditions, housing starts, the ISM services index, those things are saying the economy's in pretty good shape. And And I think if you look at the labor market, this is where you have to say, well, we want to look at history, I want to look at the data, but we also want to acknowledge what's going on right now that is a little bit unique. And that is that baby boomers have not come back to the labor market. They probably were going to leave over the course of this decade. And because of COVID, a lot of them left in mass right away and they didn't come back. The rest of the labor market did, like 55 and under labor force participation rate, percentage of the people
Mm-hmm.
actually working, that's back above pre-COVID levels. But what this means is that there's a lot of people who of working age who maybe are getting jobs that are paying better, getting jobs that maybe they were qualified for, they couldn't get because baby boomers were there. And this has led to a tighter labor market. And you have an economy, Ryan, that's
Mm-hmm.
2/3 consumer spending, and you're getting 150,000 jobs a month. It's pretty hard to get a recession.
Yeah.
Speaking of, it's interesting. Like that's such a good point that you brought up about baby boomers leaving. I imagine also back in 2008, I mean, you had the crash, and a lot of people had to come back into the labor market because of real estate crash, stocks crash, you're worth more. But now stocks are up. I mean, Ryan and me were talking about this the other day, 50% since 2019 and 2020, 21, 22, 23. Yes, last year was a bear market, but big picture over 4 years, minus 1 month, I suppose. Stocks are up 50%. So everyone's worth a lot more. Real estate also worth. Maybe you're locked into your home because you don't want to get rid of it. But I think most baby boomers have probably paid off the home anyway. Right. So that's probably another factor there. And you know what? Maybe we don't have to go back to work.
Yeah, here's an interesting stat where about a third of all homes are owned by baby boomers, and half of those, so about 1/6 of all homes, were bought before 2000. So, all that rate sensitive. They now it's a challenge if you want to move. I think one of the things we've seen is that you slow down in labor force mobility. If you're in California, you want to move to Texas, get a better job, do the cost of living adjustment. Now that you adjust for higher mortgage rates, and costs have gone up in places like Texas and Florida where I live. Okay, so maybe you don't make that switch, and that's why you've seen the quit rate fall by just roughly half. So you've seen that change, which may lead to lower wages, right? So people are not competing as much, and willing to move as much. So that is a little bit of a double-edged sword, slower economic growth, but that may make the Fed's job a little bit easier as wage costs perhaps come down. So that's why, again, we don't want to get too hung up on one data set, one indicator, because there's so many unique things going on right now. If this one thing, like the yield curve, well, the yield curve's inverted, therefore we must go into recession. That's something to keep an eye on, but there's other things.
Right. You mentioned 30% chance of a recession. It struck me immediately. I guess next year's an election season, so there will be politics involved all through next year. If you had back in 2016, I think former President Trump had a 30% chance of winning the election, and he did. So 30% events can happen, right? But I'm curious how the fact that next year is a presidential election year, and I know Ryan does great work around this too, and you guys do too. But how that's gone into your thinking of what the S&P 500 will do next year?
Yeah, it's part of it because absent some sort of crazy market event and external shock, the market does have a rhythm to it, and that's why something we call our cycle composite, which combines the 1-year cycle, the 4-year cycle. So for next year, we're talking about election years. And then the 10-year cycle, or in this case, for next year, years ending in 4. And so if you look at that 4-year cycle, the first half of election years tends to be weak. I'd call it choppy. Bear markets are unusual. I think there's less than 20% chance of a bear market occurring, but it does tend to be choppy because the uncertainty over the election, who's going to win. Now, on average, the market bottoms in May, and then you get an election year rally. That's the case where the average maybe is not telling you what goes on in individual cases. For example, in 96, Hillary Clinton was going to get reelected. There were 2 small corrections early on, and the market soared back half of the year. Of course, there's a lot of other stuff going on with the internet and profits were booming, et cetera. 04, very different situation. W was a tight reelection bid, and it wasn't until election night that it was settled. In fact, at one point, looked like Kerry was going to win Ohio, and he would have won the presidency.
Ohio,
Yeah. So I think his campaign manager or somebody actually said, could I be the first person to call you Mr. President? And he said, no, you're going to jinx it. And it turns out he did jinx it. But the market didn't rally until after the election. I think it technically bottomed like a couple weeks before the election, but really it took off once the election was settled. And it's just the uncertainty of knowing. And look, there are a lot of differences in domestic economic policy, assuming it's Biden and Trump again. And so that there is a lot of uncertainty. Forget about all the other stuff, but in terms of what tax policy could be, it could look quite different. So the market's going to maybe take a wait and see mode until it becomes clear. And given the reality of the situation with how polarized we are, it could probably be a close election, and that uncertainty could weigh on the market for a while.
Well, we are speaking with Ed Clissold. Ed, what's your title again? I know you said it. What's your title?
Chief U.S. Strategist.
Chief U.S. Strategist at Ned Davis Research, and the latest Carson's Facts versus Feelings, the final podcast of 2023. Ed, we're at about the halfway point. Hopefully this isn't too painful for you. So I think we've done a pretty good job talking about the Fed and the economy. And now let's kind of spend a little bit of time talking, probably most people want to talk about equities here, maybe a little bit of bonds as well. As I looked at your 2024 outlook, one thing struck me that interests me, because we at the Carson Investment Research team have been overweight small and mid caps here for a couple of quarters. Little painful, yes, but all of a sudden it's doing a little better. I noticed you guys on your team are also at least eyeballing small and mid caps. Can you talk to me about kind of some of the potential reasons someone should think about overweighting small and mid caps next year?
Yeah. So, well, first of all, where we are right now, we're still favoring large caps. We're kind of preparing people for a potential rotation.
Yep.
And first of all, from a cyclical standpoint, the back half of election years tends to favor small caps over large caps. When you get that second half rally, the beta effect, small caps tend to be more volatile in the overall market. So market goes up, they should go up more. But one thing we're really keeping an eye on is what goes on with interest rates in the yield curve. When the yield curve is inverted or long-term rates are lower than short-term rates, that tends to be negative for small caps relative to large caps, because they're more sensitive to the economy. So that inverted yield curve usually tells you the economy's not doing that great. So that there's that message. But also there's a lot more financial stocks and regional banks in the small cap benchmarks. And an inverted yield curve, of course, is negative for banks. So it's going to hurt small more than large. And then this year, what really is coming home to roost is that with rates going up, companies are slowly going to have, each year, they're going to have to refinance their debt as their bonds come due at higher rates. And small caps generally have shorter durations of bonds. So they're going to have that comeuppance is hitting them sooner than large caps, who, they're able to maybe issue, very long-term bonds. The other thing is, in these really cash flush companies, these mega cap tech companies, they have so much cash, they're actually making more interest income than they're paying out in interest expense. Small caps don't get that benefit. But if the yield curve steepens, that goes away. And small caps are historically cheap. And so, if you get that catalyst of better earnings growth, then, their low valuations could allow that to run maybe more than what a lot of people think.
Yeah. I like what you wrote in the outlook about, like, small caps haven't had a catalyst, but now that catalyst going forward could be the yield curve uninverting and long-term rates rising above short-term rates, potentially, right? And Ryan and I were asked this question a few months back. I forget who asked us exactly. So I'm going to ask you that as well, Ed. What grade would you give Jay Powell? Taking the totality of everything for 2018, 2019, obviously 2020, and then again, everything last year and this year.
Yeah, I'd give him a B. And I'd give him post 20, call it March of 2019, probably more like a B plus. So I'm probably more generous than most. He really misunderstood how the Fed worked. That was a novice move in 2018, where he said, we're going to raise rates and we're going to get away from this Fed managing the markets. And then the market said, oh, we'll teach you. And Fed and Powell had to do a reverse course in early 2019. But This was a really challenging environment. You think, well, why did the Fed wait so long to start raising rates? Well, there was a lot of concern over whether the economy was going to be shut down again. There's a lot of concern over COVID and supply chains. And so, obviously in hindsight, they would have certainly have moved faster. But if he's able to land this plane, I think this is like an all-time great Fed move. If he can do that, because I think if you had talked to people when we did the third round of stimulus checks in March of 21, said, well, we're going to do this, but if the result is you get a recession in a couple years, people would probably say, well, we'll take it. And so that's a challenge the Fed has so far been able to overcome. And I'd say one more thing, and this is the politics of it. The reality situation is Powell was talking transitory for a while, and then when he was renominated by Biden, he then stopped talking so much about transitory, but then he really didn't talk about raising rates. It wasn't until it was confirmed by the Senate that he then got serious. So unfortunately, there was a political aspect to it.
Sure.
And maybe if he was confirmed 4 months earlier, that he could have raised rates earlier, and maybe he shouldn't have done that. Maybe he should have just done what was best. And, of course, they're never going to say, hey, we were waiting on confirmation before we raised rates. But it was pretty noticeable to me that as soon as that was done, that the Fed pivoted to aggressively raising rates.
That is really interesting. I guess I'd heard that before, but the way you explained it made a lot of sense that maybe there's some bigger forces in there potentially. You want to keep your job. Sometimes you got to do something maybe you didn't want to do necessarily. In theory. But so we have less than 10 minutes here, Ed. So let's talk a little bit more about like sectors, right? There's 11 S&P 500 sectors. We kind of talked, you're still in large, a little overweight large, but looking for the opportunity for small and mids, maybe play catch up, maybe the second half of the year. Out of the 11 sectors, what are like 2 or 3 of your favorites next year? And what are 2 or 3 you're kind of saying you're underweighting, not saying outright avoid, right? But at least underweighting. What do you see in sectors here?
Yeah, so I think, well, first of all, right now, we do have an overweight to industrials and communication services, a little bit of a cyclical bent. What we're posing as maybe an out of consensus call is that if the market is a little choppy in the first half of the year as the election cycle suggests, as the economy cools and the recession drums beat a little bit louder, defensive sectors really oversold. And so we have something called a gut index that stands for staples, healthcare, utilities, and telecom. And it had its worst first year of a bull market ever, going back to the mid 70s. So, they usually, these are defensive, low beta. So the market goes up, they go up less. But even accounting for that, it was the worst start of a bull market ever, which a lot of these are high dividend yielding stocks. So you can get 5.5% from T-bills. Why would I want to buy a utility company that maybe is yielding less? So it's understandable, but in a choppy environment, their low betas tend to help. And so that could be pretty interesting. And then as we get into this, let's say we get election year rally, then you want to get more cyclical again. And, if the economy is actually doing quite strong, it may actually be cyclical value. That would be industrials, materials, energy, and financials.
Yep.
If not, then maybe it's more cyclical growth like we've seen this year, communication services, technology, consumer discretionary. But I think there could be a transition back into cyclicals, as it becomes clear that recession, isn't coming to pass.
Got it.
I was curious just again, while on that sector topic, what you think about tech and maybe broadening out to Magnificent Seven, right? Because it was a horrible 2022. 2023 has been amazing. So much so that that's all people are talking about and attributing the market rise to just the Magnificent Seven. We've been talking about that's not just the case, but still, right? It's a big part of what's happened this year. What are your thoughts on what happens next for the Magnificent Seven?
Yeah. So a couple things. One is, I think, maybe against conventional wisdom, is that the higher short-term rates were actually good for them, and higher rates in general. And the thought was these are quote unquote long duration assets, meaning that if rates go up, that means when you do your discounted cash flow and you get the net present value of the future cash flows, these companies are going to earn more in the future, right? That's lower, and that's bad for them. But that's exactly what didn't happen this year. And I think the reason for it is, let's say, you're putting together your portfolio, you're an individual investor. You're going to put a chunk of your money in T-bills, and you go, I'm going to put some in stocks, but I'm only going to put them in stocks that I think can really outperform over the long run. I may not be, not knowing what some of these companies are going to earn next quarter, but I think over the next few years, they're going to grow a lot faster in the market, i.e. the Magnificent Seven. And so that there's this bifurcated portfolio strategy out there, which is T-bills plus Magnificent Seven. So if rates come down, that could kind of reverse. From a more fundamental standpoint, these companies, so we took the Elite Eight, so we added Netflix to the Magnificent Seven, but they're 29% of the S&P market cap. They're 19% of earnings, so basically a 10% gap. And that's one of the widest on record. So they've already risen in anticipation of their profits growing a lot faster in the market. So those profits better come through, and better even come through even more to justify what they've already done, let alone if they're going to continue to outperform. So so I wouldn't be surprised if they took a breather, with a big caveat. Look, if they actually do come through with these fantastic earnings growth, why not own them? But history says there'll be some mean reversion, and I wouldn't be surprised if you get some of that next year.
Yeah, very interesting. So we've got time maybe for a couple more questions here. I did notice in one of your recent notes, and usually your name's up top, right? So I see that. But you have an analyst on your team with, I thought, one of the coolest names I've ever seen. London, is it Stockton? Is that his name? London Stockton? I mean, that's like, he's in the right field. Is that his name, right?
Yeah, you got it. Yeah.
Okay, is he relatively new? I haven't seen his name, or maybe I just missed it.
He's been there for a long time. He was Ned's right-hand guy. So those of you who don't, maybe aren't subscribers to Ned Davis Research, so there is a Ned Davis, and he's still around. He's just not writing his hotline publication 3 days a week anymore. And so London stepped in to write some of them. Yeah.
Got it. That's a great name for given what we do as a profession, I thought. All right. So kind of my final question for you, Ed, here. And again, we're joined by Ed from NDR. We are huge fans of Ned Davis Research here in the Carson Investment Research team. Use you every day. You've been great partners. On the YouTube channel, Sonu, let's point it out. Turn around, Sonu. Let's look at the back of your shirt for the YouTube channel here. This is the Facts versus Feelings t-shirt, officially sponsored by Ned Davis. There you go. So they help sponsor those. I guess that was an event we did in where were we? Excel at Nashville. They were big sponsors and partners there, and they helped with those t-shirts. So that was great. So Ed, tell us a little bit more about where people can learn about you, learn more about Ned Davis Research, where they can go. And do you just service financial advisors? By the way, as you probably know this, we do have a lot of financial advisors listen to this podcast, but we have more regular investors. Kind of what's the spectrum of people you can help potentially?
Yeah. Well, first of all, you can find us at www.ndr.com. And we're on Twitter at NDR_research. And I'm actually on Twitter at Ed Clissold. But so our client base actually runs the gamut. We hedge funds, pension funds, endowment, long only, mutual funds. We actually have quite a few advisors, advisor networks, individual advisors on our platform. As the industry's changed, and there's, that's been a growing part of the business, that's become a bigger part of our business too. And so what we try to do is we have a few different products that maybe can meet the needs of different groups that are options, but the underlying research is the same. Data driven, quantitative, objective research.
Yeah, well, I'll just say this. I mean, that's why I'm a fan of it. That's kind of the way I grew up, right? Looking at percentages and numbers and hard data versus soft data and those types of things, and why we call this facts versus feelings, right? We are fully aware feelings matter. They matter a lot, but the facts are also very, very important. So Ed, I'll just say thanks again for joining us. This was awesome. Sonu's going to fire away with the last question. I don't know. We didn't have this planned. Let's just see what he's got up his sleeve here for you, Ed.
No, we'll just make it simple. I think obviously Ryan and I know this because we've looked at the outlook. Hopefully, definitely check out the outlook for those of you who are listening, want to look at NDRs. It just showcases everything they bring to the table, right? And that's why we love them. What is your target for the S&P 500, and what's your target for the 10-year interest rate, treasury rate next year?
So we're going with 4,900, which is about a 7% increase for next year, and so that's continuation of the bull market. Again, probably if you're going to get some pullbacks, a bigger correction, it's more likely to come in the first half than the second half. And then for the 10-year, actually, we're looking for it to continue to decline. Fair value could get to around 3.5%. So that's a pretty significant drop from here. And that's where, as inflation comes down and growth comes down, there's going to be room for rates to continue to work lower. And obviously, if you get lower rates, that's good for stocks as well. So the two are working in tandem.
Yeah.
Nice.
Yeah.
Thank you.
Absolutely. Well, Ed, thank you so much for taking some time joining us on the Facts versus Feelings podcast, the final one of 2023. I almost said 2024. That's interesting. I'm looking to the future, the final one of 2023. And again, this was episode 65, sponsored by our friends at White Charts, discussing NDR's 2024 outlook with Ed Clissold. Ed, thank you very much. Can't wait to read more of your amazing researcher and the team, and definitely check out Ed and his team and the team at NDR. If you haven't ever heard of them, or if you have heard of them, look it up because they do some great work. Ed, take care. We'll see you next year, I guess. Is that what we're supposed to say, right? We'll see you next year. Take care. Thanks, everybody.
Happy holidays to you guys.
Thank you.
Too.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.